June 20th, 2024. I wanted to make a review for June 20th because I thought some pretty interesting things happened. You can see the market's actually open right now, but I'm not trading because I'm away and I'm making this recording on my laptop, so it might be a little bit weirder than normal. I'm using my headphones, so if it sounds better, that would be why. Bar one. So coming into the day, well, not coming into the day, but at the end of the day, we had an outside down day. So whenever we have an outside down day where the market trades above the prior day's high, fails, and then reverses down and goes below the prior day's low, there's a 70% chance that it's going to close in the lower third of the day. And you can see at the very end of the day, we did get back into that lower third, basically right on bar 81, because traders know there's a 70% chance that we're going to close within that lower third. Bar one, a bear bar, but a big tail on the bottom. Not really worth selling. You can see, I don't count these as days, by the way. The half day stuff, I just ignore it. But really important that you can see that there's still an open gap with bar one low in the prior day's high. So bulls have an open gap. What they're going to try and do with that open gap is turn today into a big bull trend day. But the problem with that is we're pretty overbought on the daily chart. And we're probably due for a pullback and to go sideways to down for, a couple of days at least. If you just look, ignoring the past 2 days, so ignoring this and ignoring this, you can see we're just relatively overbought in general here. So probably this inside bar is, or it's not, I don't think it was actually quite an inside bar, but this bull bar is probably not going to get a huge bull bar's follow through. It would be rather unlikely. So overall, the odds of a strong bull trend day were not all that high today. Oops. Bar two, an inside bar closing near its high. It's a reasonable buy above two, taking a chance that we've seen the low of the day. You can see with the open gap, that would be the first open gap that the bulls want to form. They're going to want to form a second open gap rather soon in order to get a potential bull trend from the open. And you can see we got a surprise bar up on three. But the problem with three is a really big bar. So whenever you get really surprisingly large bars, a lot of times it just ends up becoming a trading range. So if you bought above two, a lot of traders, when they see three, they're kind of just thinking to themselves, I didn't really risk much. My true risk is very small. I probably have 4 to 5 times my true risk, and huge climactic bull bar closing on its high probably makes more sense to take some profits than it does to just stay in the trade. It's reasonable to stay in the trade and it's reasonable to buy the close of three, but it's not as ideal as it could be because whenever you're getting huge climactic bars, you have to be thinking about a possible trading range. It is, again, early in the day, so it's not unreasonable to be long above three, but in general, I think if you bought above two, probably take at least a piece off during three. And that's why you don't get the follow through you want on bar four, is because of how climactic bar three is. So if you bought, bar three or bar four, and then you thought to yourself, well, why, if you bought bar three and then you thought to yourself, well, why is bar four so small? It's because traders weren't as willing to buy because the risk is now huge, right? And your probability is reasonable, but it's early in the day and there still can be violent reversals. So a lot of traders are looking to take a piece off. There is also another important fact in that the bar one high has now become an open gap. So the traders who, let's say there are a lot of traders saying, well, yeah, I know that, bar two, 30% chance that that's the low of the day, but I think that it's still reasonable to sell above bar one. Once we trade above it, taking a chance, 70% chance I'm probably going to make some money. So those traders, they sold and then bar three closed on its high and they thought, uh-oh, I might be trapped. So they're still going to scale in, but they need the market to get back to here in order for them to get out of their shorts at break even on their first entry and with a profit on their second entry. So for me, I think this is going to be a price the market's going to pay attention to if we get back to it. Bar five, bear bar closing near its low. You can see it's disappointing. So we got pretty good follow through or pretty good bull bars here, but bulls just end up a lot of them taking profits. You can see we rallied back to the close of bar four during bar five. Some traders maybe bought the close of bar four, hoping it was going to be a huge bull bar. And then when it wasn't, and even when they got the micro gap down, they were disappointed and they got out of the trade. Similarly, traders who bought above three, hoping bar four looks like three, they don't get it. They just use the tail on bar five to exit their trade around the close of bar four, and that's causing a lot of the selling here. Maybe some selling pressure from bear scaling in, but as you can see, this is basically a doji bar, right? For all intents and purposes, you could probably treat it that way. So it's probably going to start to go sideways soon is the point there. Probably not worth selling below five after 3 straight bull bars. You could sell it arguing that bull trap early in the day and it's a possible high of the day, but I would rather wait. 6, follow through for the bears. You can see we got back to the one high. There's probably buyers there though. And, it was more of a breakout test of the bar 2 high. And as you can see, I don't think we overlapped with it. We kept the breakout test gap open here, but you have to ask yourself, does this look like the start of a big bull trend day? Probably not. It's probably going to be a trading range day. By the way, what we're doing here, I think, well, first off, not good that we got a micro gap down here because strong bull bar 9, yes, but right to the moving average. So, hard to buy above 9 because your risk is rather large. And I'm going to make a point about this over here, but I think it's tough to buy above 9 because your risk is really big. You probably have to put a stop at least here and theoretically down here. So, is it reasonable to buy the close of 9? Yeah, but this is the best looking bull bar you've gotten so far in this 3-bar rally. So I would not be surprised at all if we got a reasonably decent bear bar closing near its low on bar 10. And also, the bulls who bought above bar 1, they might be looking to sell out of their longs up here rather than buy more. It's credible to think we've seen the low of the day so far, but I'm not sure we're going to go straight up. But I think that the targets that it's looking for are probably somewhere up in here. So it's, again, like I said, it's not unreasonable to buy the close of 9 because sometimes, you're looking for the vacuum test somewhere up here, but it's just really difficult to do because you're buying right on the moving average with big risk. So that's the problem with that trade. So bar 6, you can see we found buyers at the one high, and we got a bounce on bar 7 because the traders who sold, or who, like I said, sold the one high and scaled in higher, they exited their trade, and that's what caused the bounce on bar 7. Bar 8, a bear bar closing near its low. It's a bear surprise, so it's good for the bears, and we're closing below the moving average, which I think is really important. But you also have to be wondering, possible second leg trap, 5, 6, pullback, and then 7. And with how strong this is, how far below this are we going to trade? So my problem with selling 8 is your reward is probably relatively limited. At this point, it's probably a trading range open, right? This is not a bull trend from the open. So we need to be closing gaps. So what gaps are we probably going to close? Well, we're probably going to close the gap with yesterday's high. So we're probably going to get to at least down here, but that's only, you're only going to make 2 or 3 points if you do that. So it's really not all that great because you're selling below 8, again, your reward is probably limited to a handful of points. So it's not as good as it could be, especially considering the fact that bar 8 is a relatively large bar and your risk might be somewhat big. Bar 9, follow through for the bears, but a big tail on the top. So I'm not really sure that it's worth a sell to close bar on 9 because of the big tail. And additionally, something you have to keep in mind, 2, 3, 4, pretty strong. So even though we have an open gap here now, you can see that it's probably going to end up closing. So sell the close not all that strong on 9, and this might be more of a profit taking area for bears because the traders know that we're probably going to pull back to the 1 low at some point today. So that the bulls who bought below 1 and scaled in are unlikely to get trapped. So that's probably what's going to happen. That's what's happening here, or what's going to end up happening over the course of the next couple bars is bears will take profits. 10, follow through for the or inside bar for the bulls, or sorry, for the bears. It's a low 1 short closing near its low. Is it worth selling the low 1? Probably not really. I don't really think it's all that great. It's after a bear surprise and it's a low 1 short in their bear trend, so it's a reasonable argument, but I don't know. I still think the bulls are going to make money, and 2 and 3 are really exceptional bars. So I'd be kind of surprised if the market just ignored them, which for the record, it kind of did, which is, pretty important that it ignored them like that. But I don't know. Sorry, I got distracted for a second. But something interesting is your only chance to get out would be if you had bought above the close of 17 or bought above 17, and then because remember, if you bought the close of 3, 60% chance we get back to the bar 3 close, and 80% chance if you scale in above a bull bar, you're going to be able to make money here. And your only chance to do that was buying above 17, and it's not very good if you're doing that because it is a double bottom, but it's just not as good as it could be. If I had bought above 9, this is another problem with this trade, by the way, is do you have to exit below 10? It is a double top, but if 10 closes near its low, which a lot of times it does, because what you really don't want is for 10 to close on or near its low, and so that's exactly why it does a lot of times, forcing trading range price action. How do I know that stuff? Because I've bought above bars like nine just a gazillion times in my life, and I always feel like I end up disappointed when I do that because it's probably a trading range, and if it is a trading range, the pullback can be deeper than you'd like it to be. So I'm not really sure. Again, like I said, this just oftentimes at the moving average, big risk, disappointment, and it's the same concept with bar 18, I think, but I'm going to get there. Bar 11, you can see we never triggered below 10, and you get a disappointing bar 11, huge tail on the top, and probably overlapping with one. So you can see um, traders. Sorry, I'm watching this right now. I got to give a little more focus here. Okay, you can see traders disappointed in how bar 11 closed. If bar 11 had been an inside bar, it would have been a sell climax and then an II pattern. So 10, 11, inside pattern. And probably buyers above had you gotten a sell climax and an II. But you didn't get that. You got a disappointing bar on 11. So probably not all that many buyers above 11. 12, follow through for the bulls. Again, trading range price action. When you get a trading range price action, you expect gaps to close. I thought the 7 low was going to be a reasonable target and potentially even the 8 high. So 7 low, 8 high, 8 high, sell climax high, 7 low. You can see probably buyers not too far below. 13, a doji bar. It's a low one short for the bears, but there's probably buyers not too far below. We might get a second leg down from 7 or from 8, 9, and 10, but I do think that 11, 12, 13 strong enough for a second leg up, at least maybe test of the open of the day, maybe test of the 7 low. 14, disappointing bar. So you can see we got buyers below 13 and a reversal up, a bull bar closing near its high. I don't really think worth buying above 14. It looks like a second leg up. 15, buyers below 14. But again, what do traders want out of this? I guess is the point. Well, bulls, they want, this pullback to turn into some sort of higher low major trend reversal, or even a lower low major trend reversal is fine because the lower low major trend reversal could be a wedge, 1, 9, maybe like, how do we got down? I don't know, 19 or 20, somewhere down here. So bulls are okay if we do that and we form a wedge. What do bears want? Bears want some sort of consecutive bear bars closing near their lows and to be able to sell for a big swing down. But it's less likely, I think. I think it's more likely that the bulls get what they want and we get some sort of higher low and at least a bounce because this looks like a trading range to me and we're relatively low in the trading range, so I'm not expecting a breakout. 16, a bear bar closing near its low. Disappointing for the bulls. If you bought anywhere in here, I don't know if you have to exit. It's kind of a tricky situation. A lot of times 16, you get a big reversal up on 17. 16 is really not all that good after 3 doji bars and 4 bull closes over here. So 4 bull closes is too many. A lot of times in a pullback, when you get a bear trend, you have 1, maybe 2 bull closes. But when you get 4, that's just too many. So I think probably trading range. 17, a bull bar closing not quite near its high. It's a bit disappointing. You can see near the moving average, it's a double bottom with, probably, I guess I would say 10 essentially, since that was essentially the signal bar. But you can see not a great signal bar, not a great signal bar neckline, but not a lot of great bull closes here. So the upside here might be limited with how this looks. You can still buy it. 18, it is buy the close 18. Yes, you can buy it, but the problem is your magnets right here and maybe up here. There's a 90% chance every day that we're going to break out of the 18 bar range. So it's reasonable to buy above 18, taking a chance that we break up to the upside side of the 18 bar range because then your reward is 9 points and you're only risking 6.5. So it's not so bad. But the problem in general is that the risk is relatively large from the 16 low to the 18 high. The bull closes in here are not all that ideal. So while you can buy above 18, you have to keep in mind your risk is relatively big. When your risk is big in trading ranges, this is what happens. You can see traders, they bought above 9. They're disappointed 10. They use the rally on 11 to get out during 10. So if you're taking this trade above 9, you can't just buy it and see this and say, dang, well, maybe it'll go up. No, you need to get out. So that's the trade you took. And the problem with these big bar, big risk trades is the management can be really tricky. So if you bought above 18, what happened on 19? Well, disappointment on 19, right? So possible wedge, 9, 13, 19, and then 20. Why does 20 happen? Well, traders know there's a magnet above, and now what they can do, rather than risking all the way down here, they can just buy the close of 19 and put a stop directly below it. They know that a lot of bulls are probably just going to exit if we go below 19, so they just simply buy the close of it, and they try to get 20 to rally up to the 7 low, and that way, if you look, they're only risking 1 point, and they're trying to make 3 points, and they have a reasonable chance of success. So that's actually a pretty okay thing to do. 20, a bull bar, closing kind of disappointing. It didn't close above the 19 high. So if you were a bull, you wanted a strong breakout here, and you did not get the breakout above the 19 high. So I think that's rather disappointing. 21, an inside bar, but this is not ideal. If I had bought above, I did buy above 18 on this day, and when I saw 21, I just got out because it's not very good. I didn't do very well on this day, by the way, because I was too distracted. Which is one of the reasons I'm not trading today, is because I just got so distracted yesterday because I was trying to get on a flight and stuff, and I was trying to trade at the same time. And it's just never a good idea. But anyways, an inside bar 21, a high 1. Better to wait rather than buy above that. At this point, you're buying in the middle of the trading range, and your risk is somewhat uncertain. And then 22, disappointment, a bear bar closing near its low. It's a wedge, 9, 13, and 20. But are you looking to take the short below 22? I don't know. You're probably going to get 2 legs sideways to down, but this is a reasonably tight channel up. The same way that it was reasonable to buy above 18 and just take a chance we go up here, it's probably reasonable to buy below or sell below 21 and take a chance we at least get somewhere down here. But 2021 could be a little bit of a problem. We might have to get back to the 21 low. 22, follow through for the bears, but it's really not all that good. There's a big tail on the bottom. You can see traders are scalped. They end up scalping with like 2 points. During 23. 24, an inside bar, a low 1 short. It's okay to be short, but it's really not all that ideal. You can see traders, they scalped at this price, and so they're using it again to scalp out. Basically, the 16 close, bear bar closing near its low, so it's going to be a magnet, and that's what happens here. 25, an outside up bar, but it's a first reversal up after 3 straight bear bars. It's not worth buying. It's disappointing it's not able to close above the moving average. And then 26, a bear bar closing near its low. And really important that we haven't been able to get a strong close here above the moving average. So we're failing at the moving average 25, we're failing at the moving average 26, and then 27 again unable to close above the moving average. So we fail at the moving average 27. So 3 straight failures at the moving average causes bulls to give up, and then we get a big bear bar closing near its low 28. 29, an inside bar. Tried to get back to the 27 low, but weren't quite able. A lot of the traders who bought below 27 were extremely disappointed with how the follow through was, so they scaled in and quickly got out on 29. 30, a low 1 short. So we have an II pattern, 29, 30. Probably sellers not too far above if we rally. Probably buyers not too far below. Disappointment, 31. You can see we're breaking below yesterday's high. It's a possible wedge, 1, 9, 30. It's a bear channel, right? The important thing to notice here is we're getting all lower highs, 4, 21, 27, and then 34, and we're getting lower lows, 1, 9, 31. So we keep getting lower highs and lower lows. We're probably going at least a little bit lower. And you can see 31, disappointing, and then 32, a doji bar, because a lot of traders, if you're selling below this is a pretty sensitive trade. You want it to go pretty quickly, and it didn't. So a lot of those traders exit, and that causes 32, the doji bar. 33, an inside bar, or not quite an inside bar, sorry, probably sellers not too far above here. Again, 31 was essentially a high 1 for the bulls, or I guess you could argue high 1, like a high 2 for the bulls, but it's really not that good. It's a bear bar, so your follow through is not going to be that good. What a bulls want, maybe one more leg down and a good clean looking reversal bar up. This could be possibly be a final flag. It's a tight trading range. So if we do get a smaller reversal down, like a weak breakout and then a clean reversal up, a reversal up from a final flag is generally a relatively reliable trade. 34, bear bar closing near its low. It's a bear channel, right? It's maybe a little less good that it triggered below 33, but also for the bears, it at least breaks out below 33 and try to close below the tight trading range. It's good that it closed below. It's the lowest close so far today, right? So it breaks out below all of the low closes. So it's a breakout on the line chart, which is important that the bears are getting their strongest close so far today. It's also a low 2 short at the moving average on a bear channel. So when you're in channel days, you want to be selling at the moving average, low 2 shorts, etc. And then you get a big surprise, 35. This is not a breakout below the final flag, and you look for a reversal up. This is a new breakout and a big bear surprise on 35. Follow through 36, consecutive bear bars, sell to close. Follow through 37, again, more sell to close. We're going down. I'm not sure how much further down we can go. Again, that ended up being a trending trading range day. So you have the upper trading range, and then you get like a 5-bar breakout, and then you have the lower trading range. That's what usually happens. So 36, 37, really good bear bars, pretty climactic. And then disappointment 38, Not really worth buying above 38. It's probably just a place though to take profits. I think if you sold anywhere in here, you probably made decent money, and you should probably just get out above 38. And you know that a lot of bears are going to do that. Any bear who sold 34, 35 is probably scalping a piece down here and getting out of the rest above 38. So you know the bounce could be a little bit deeper than you want it to be. 39, follow through for the bulls, but just traders exiting, and more follow through. 40, again, traders exiting. But these are not great bull bars. There's tails on top, 38, 39, 40. So it's a micro wedge, and then a reversal down 41. I would not sell the doji bar, probably at least a second leg sideways to up from the rally, but 42 is your second leg sideways to up. So not really as good as it could be. 43, a big bear bar closing near its low. Are you selling? You can probably take the short, but I'm not really sure it's worth doing after the 4 straight bull bars. Your downside's probably limited, and it's probably going to go more sideways to down. 44, follow through for the bears, closing at the new low. Again, I'm not really sure how much lower we're going to go. Probably sellers not too far above 44, but the 4 straight bull bars was a bit disappointing. So this might be forming some sort of channel, and then a reversal up 45. What the reversal up on 45 tells me is that the market's paying attention to this, and we have 1 low, 2 lows, and we might get a 3rd low. 46, a doji bar, probably buyers not too far below, but we could, the second leg down from this, we could at least get that new low. So I would not buy below that. Again, I think 1, 2, and maybe we get a 3rd low. 48, a doji bar, disappointment. So disappointment for the bulls, but we're probably getting back somewhere up here, and then outside down 49, small open gap with the 46 level. We're probably getting back there. Reversal up 50. 50 is not a very good reversal bar. You're not buying above it, which is why we tested back to it later today. It was a generally overall bearish day, so you know that even when we got the rally, it was probably minor. We're going to test back to here. We got a big bull surprise 51 from the wedge channel. Reasonable to think we're going to test the top of the channel, and the top of the channel is the 41 high. So reasonable to think we're going to get up here. Some traders might buy above 51. An inside or disappointment bar 52. It's not really that surprising though. After 4 straight bear bars, you probably know we're going to go more sideways to up rather than straight up. 53, a bull bar, but not really all that good. It's a high one. Do you buy it? I don't know. I mean, you probably can. I think 51 is probably the buy. It's just big bar, big risk, but you're buying pretty low, so it's more reasonable to risk a large amount when you're buying low. The problem with buying above bar 18, like I had mentioned earlier today, is that you're buying higher in this range than you wanted. So you're buying in the middle of the range. And the problem with buying up here is you're buying the top of the range. So you don't really want to be doing that. You're buying right where some traders might be exiting their longs. So you might get something really disappointing here rather than a good follow-through bar. 54, a bull bar closing near its high. Reasonable by the close above moving average. We're probably going to at least here. Follow through 55, but trading range, right? This isn't a bull trend. Your best case scenario, we probably close the gap with the 34 low. But again, you have to keep in mind trading range price action. So when you get the big consecutive bull bars and we're always in long, this is actually probably the profit taking area. And then you get some disappointing follow through 56, traders exit 57. Probably sellers above 57, not too far. Again, we've tested the top of the channel here. I thought you could argue that 36 high with the big tail was the first pullback and the top of the channel, but I thought, it was clearer. The 41 high was more clear, but it was not an unreasonable argument to say that it was the 41 high instead, or the 36 high instead. 57, buyers below 56 for a second leg up, but we're not going too much higher. Probably sellers above 57, and then outside up. We trade above it on 58, and then we go outside up 59. Bull bar closing near its high. Are we gonna get a big rally off 59? Probably not. Looks like a third leg up. 1, 2, 3. So yes, always in long, and bull bar closing near its high, but it's a trading range, and we're probably all done to the upside for at least a little bit. 60, disappointment, and then reversal down 61. Possible wedge 1, 2, 3, or maybe 1, 2, 3. Hard to buy after the 3 buy climax. You can see it's 3 legs up, 1 pullback, 2 pullback, 3 legs up. But it's hard to buy up here, I think, hard to short with how strong these legs up were. You can definitely sell below 61, but I think it's just hard to do with how insanely strong these legs up were. But you can definitely do it. That this is this is probably an area where we should test back into. So even this, we should probably test back to this high. So you can look at it and say, yeah, it's pretty strong, but trading range. So maybe we're going to test to at least the midpoint. So pretty reasonable short below 61. follow through 62, um, but not all that ideal. An inside bar 63, but probably buyers not too far below the low one short. And then 64, again, an II pattern 64, probably buyers below, probably sellers not too far above. You can see buyers below 64 during 65, 66 outside down, probably getting a second leg down. And again, there's magnets below, so you can sell. You get follow through 67, 68, a bull reversal bar. You can buy above 68 if you want, but you need a wide stop. We just had three pretty strong bear bars, and we might have to get all the way back to the 50 high. So it might be better to even wait rather than buy above it. But if you do buy above it, I don't think it's unreasonable with a wide stop. 69, follow through for the bulls, and then 70, a bear bar closing your low. I'm not selling. I'd rather just wait. And then you can see when we touch the magnet, that's what causes 72. You're thinking, how does 72 happen? It's because the 50 high. And then so traders buy back their shorts at the 50 high, and that's causing this huge rally. But again, probably not much more left to the upside. By the time it's by the close, it's by a pullback, not by the close. And you can see traders probably bought somewhere around 50% in that general area. For stop orders on the day, 2 was fine. 3 was not unreasonable, but not great. 8 was probably fine, but you probably need to get out somewhere in here. 18 is fine, but you got to find a way to be out pretty quickly. I would say below 19 during 22 at the latest, or below 22. You could sell 22. Maybe we're back to always in short 22, but tricky. 34 is probably the best trade on the day, and then sell the close. Maybe try to sell below 37, but don't get filled. Me personally, I wouldn't touch something like this. I'd be looking for the bottom of the wedge channel and the reversal up 51. You can buy that and then follow through 53, 54, whatever. And then maybe 61. So what do you expect on the next day? Well, had I not seen any of the next day, I would say disappointing bar, but this is not going to be all that great for the Bears. I don't think we're going to go a whole bunch lower, right? Why? Because, as strong as, it's good for the Bears that they got the pullback, but how much lower are we going to go? It's not that likely we vacuum test now. We might have to bounce back to at least this low first. But it is notable that the traders who bought below that low during the sell-off already had a chance to get out. So it makes it a little bit less of a magnet, I think. But we should at least close the gap with this low. So we haven't closed the gap yesterday's low yet. Really? Oh, I thought we had. Oh, okay. On the E-mini we have, I guess. I don't know. Either way, I don't. I think the downside today might be a little bit limited, but I wouldn't be surprised. I would just pay a lot of attention. Again, the thing to keep in mind at this point in the day is that the daily range is 18, and the daily range yesterday was 50. So that this daily range is probably going to at least double. So there's not really a rush to be buying high and getting trapped and selling low and getting trapped. It's probably better to just wait for the breakout and see what happens, and then take it. But it's notable that we keep failing at the moving average here. Failure at the moving average. Failure, 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 failure. So that's good for the Bears. The Bulls need a pretty strong breakout above it. And I guess we'll see what happens. All right. That's the day.